Okay, welcome everyone. This is the next webinar installment in our series of the wealth space, and our topic for today is responsible investing. Before we begin, we acknowledge the traditional owners and custodians of the land on which we live and work. We pay our respect to elders past, present and emerging, and we extend that respect to Aboriginal and Torres Strait Islander people joining us online today. So my name is Kelly Kennedy. I'm a financial advisor at BDO Private Wealth Advisors in our Sydney office. And today I am joined by David Woolley.
Thanks, Kelly. Hi, everyone.
David's an advisor in our Brisbane office. So we have some housekeeping for you. We'll just quickly go through that. To start off, you're all automatically muted. We will have time for questions at the end, and you can submit these using the question tab. However, if we run out of time to respond, we'll follow up with you after the webinar's concluded. If you have any technical difficulties during the webinar, there's a support button on the, it's one of the bottom tabs on your screen. And finally, today is being recorded, so all registrants will receive a follow-up email containing the slides, a link to the recording, access to register for future sessions. It'll also have David's and my contact details. We also need to provide a general advice warning. So the information discussed today is general in nature. It does not take into account your personal circumstances, and it does not constitute legal or financial advice. All right, so that is it for the formalities. Let's get into it. So today's topic, as I said, is responsible investing. This is a very broad topic, and it's rising in popularity as more and more people are realizing that not acting is going to be costly, and it's going to take a collective effort and action to make improvements. We're seeing a lot of the younger generations, they're the biggest drivers of change. They're putting their money where their mouth is and aligning their investments with their values. Whether you call it responsible investing, ethical investing, green investing, there's a wide range of areas of interest, drivers, concerns, methods, and there's also plenty of terminology to get your head around. So today we're focusing on this topic with an investment lens. So we hope to demystify some of that for you.
I think that's right. I think that slide Kelly just showed, I think highlights that this is a pretty big topic. But as you said, we're taking that perspective really from an investor's point of view and what they can do to start investing responsibly if that's important to them.
Yeah, and so as advisors, David and I and our colleagues, we help clients to navigate some of the complexities when they're looking to incorporate ethical or green or responsible investing into their portfolios. So here's our agenda for today. We're going to cover quite a bit of ground. I won't read out every single one of those items, but let's dive in. So what is responsible investing? This is not an official definition. It's just a summary of a lot of the areas that it encompasses. So responsible investing is the practice of making investment decisions that involves any or all of the following. So it considers environmental, social and governance issues, what we hear as ESG. You might hear ESG a lot out there. It favors companies that contribute positively to social or environmental causes. It avoids companies that contribute negatively to society or the environment or are involved in controversial industries or practices. Or it could focus on specific ethical themes. So ethical things, or a lot of this can mean one thing to one person and be very different to the next person.
So I guess continuing with setting the scene for the discussion today, ESG or environmental, social and government factors is the traditional way of looking at responsible or ethical investing. The E refers to environmental factors, the impact that a company has on the natural environment, includes issues such as pollution, mainly around carbon emissions, but also packaging, the use of natural resources and biodiversity, environmental footprint, such as energy efficiency and also green buildings, etc. From a social point of view, health and safety of employees, as well as labour and welfare standards for workers employed in the company's wider supply chain. Diversity and inclusion also getting a lot more attention these days. From a governance point of view, that's really around how a company manages its business in a responsible way, and thinking there about typically around the makeup of the board of directors and other traditional kind of corporate governance concerns. As we're saying, ESG is one of the terms that's used to describe responsible investing, and it's used sort of interchangeably with other terms like social responsible investing, green investing, sustainable investing. So hopefully we're just helping to set the scene here in terms of what we're talking about today, in terms of responsible investing.
And so it's probably a good idea to maybe have a think about, well, what are some of the drivers behind responsible investing, or what are the areas that are being addressed? There's a worldwide focus on working towards goals like the Paris Agreement from 2015, which includes the net zero emissions by 2050. Then there's also the United Nations Sustainable Development Goals, or what we might call SDGs. And a lot of the investment managers out there do try to incorporate these now. So you'll probably start hearing that more and more. So this screen here, what we're showing you is the 17 United Nations Sustainable Development Goals. And I thought it'd be worthwhile just mentioning some of the issues behind them. There's obviously a very large depth. So this is just a very small snippet, but just some noteworthy things. So more than 600 million people worldwide are projected to face hunger in 2030, and that's only 6 years away. 1 in 3 people worldwide struggle with moderate to severe food insecurity. 1 in 5 young women are married before their 18th birthday. 2.4 billion people live in water-stressed countries. The world is expected to face a global freshwater shortfall of up to 40% by 2030. 1 in 4 young people are not in education, employment, or training. And so I guess the so what is that everyone's going to identify or relate or find passion in a different area. Different things mean different things to different people. But people are starting to try to take action and put their money into something that aligns with their values. Did you have a comment there on that?
Yeah, probably. I mean, I guess from the point of view of an investor looking at trying to understand what the ESG credentials are of a particular investment, which is kind of the focus, I guess, of the discussion today. I think these are probably the closest thing we've got to global standards for ESG, because companies and funds that are a signatory to these development goals, they're required to report on activities twice a year. It's not enforced at all, but it's it's probably one of the closest, I guess, benchmarks, or, as I said, global standards that we've got for assessing ESG credentials at this stage.
Yeah. All right. So I think now we're going to have a look at our next slide, which I think is you're covering, David.
Sure. And this is looking at the amount of funds under management in ethical funds in Australia. It's a chart the Reserve Bank put together recently. They did that using effectively like a word search for terms like sustainable and ethical. So it is a fairly narrow definition, possibly, because if you ask other groups such as the Responsible Investment Association of Australasia, they come back with a figure of a much larger number, almost 1/3 of the total managed funds industry having some type of ethical criteria. So here we're looking at 40 billion or just over in ethical funds, as opposed to about 1.5 trillion, depending where you draw the line, based on how as I mentioned, the RIAA measure ethical funds. What it does show, though, I guess, is the growth over time. We can clearly see there's a trend towards more people investing this way. So there's, as we'll touch on in a minute, there was a a blip in performance in 2022, mainly around sell-off in technology companies and minor companies doing particularly well, which took away a little bit of the interest in ESG. But over time, there's definitely been a trend, towards more people wanting to invest, in this way, which is what this chart shows. And this is the chart talking about performance. And most people want to know, I guess, if you do need to sacrifice returns to invest ethically. So there's different ways we could have had a look at this question, but what we've got on this chart is performance over the past 10 years for the Australian share market and also for global share market against two sustainable indices, which there are some criteria in terms of how those indices are put together. But if we kind of look at what the outcome of this comparison is over 10 years, we can see that these two sustainable indices have outperformed both the MSCI for global shares and also the ASX 200 for the Australian share market. So, I guess the conclusion or the main takeaway there is that you haven't had to sacrifice returns to invest ethically. Just to kind of make that chart a bit clearer, we're looking at the Australian share market there in the orange line, the global share market in the light blue line, and then the green line being the global sustainable indice, and the dark green line being the Australian sustainable index. So we probably should unpack this a little bit, because if you look at other numbers, it's going to show some different results. But if we just think about what's driving the outperformance of these particular sustainable indices, there is a trend for ESG funds to be fairly heavy on technology, where the carbon emissions are relatively low, and that's also meant that exposure to energy and mining stocks are also low as part of these indices, because those companies are high in carbon emissions. That approach of investing, being overweight in tech worked quite well over the last decade, mainly because ESG investors wanting to avoid fossil fuels, embracing technology. But then we had the Russian invasion of Ukraine, which kind of changed the situation in 2022, and we saw that sell-off in tech stocks, and then a global energy crisis, energy price surge, which meant that there was a blip in performance in 2022, particularly around ethical funds, which there were a lot of headlines in papers, asking whether or not ESG investing still made sense. But I think really need to zoom out and see the bigger picture, which is what this chart shows. So the other point maybe would be just to think about what having that sector bias means for portfolios. So as we said, typically ESG funds are overweight tech. That type of sector bias means that you're going to see some volatility from year to year in returns, relative to a market index. So I think you do need to think about having a longer-term view when you're investing in ESG funds, because of that sector bias, which typically comes with ESG. So needing to be patient. And I guess the other sort of argument for ESG is that maybe the market isn't fully pricing in climate risks. So I guess the danger is that as we sort of get closer to 2030, which is a key milestone for decarbonisation, that I guess we see a big shift in policy. The world wakes up and realises that we're not on a pathway to net zero in the way we should be, and we see big shifts in policy, and all of a sudden these climate risks get priced in more heavily into markets. So from that point of view, you'd be better off and possibly being exposed to less risk by taking an ESG view, which is sort of against that sector bias issue we were just talking about a second ago. Kelly, did you want to sort of add anything to that?
Probably just the only comment I'd add is ethical or green investing doesn't mean you don't have a diversified portfolio. We still think, I guess that's part of BDO's investment philosophy, to have a diversified portfolio. And this type of investing isn't restricted to any specific asset class only. So you still have the opportunity to have a diversified portfolio across those different asset classes. So you can still have your Australian shares, your international shares, and other asset classes like some infrastructure. It just, I guess it comes down to what your particular filters are. But there are also green bonds, for example. So you can still have that overarching diversified portfolio and take that longer term view on investing. That's probably all I would add there. Did you want me to go to the next slide, David?
Yeah, thanks. And we'll come back to performance in a minute because we've got a few other examples of how ethical funds have performed relative to to more mainstream funds. This chart is looking at just the different ESG approaches, and it is also, I guess, we want to just help to clarify some of the terminology that you'll see when you're looking at the different ESG approaches that funds will take. ESG integration is probably going to be something that just about all funds are adopting these days. It's basically just good business practice, and it's just including ESG somewhere within the investment decision making for that fund. So that's ESG integration over on the left-hand side of that spectrum. The other common approach is to have some level of screening. That might be negative screening, or excluding undesirable companies, or a positive screening where you're sort of focusing on desirable factors. Norms-based screening is also something that we see, and that refers to standards of behaviour, signing up to particular frameworks, such as the UN Global Compact and so forth. So that's a common approach that we see, and we'll touch on that again in a minute. Stewardship refers to companies, and commonly, probably most practically, in terms of the examples that we see of super funds, using their power as shareholders to influence, companies with regards to, their policies. Obviously, particularly from a sustainable perspective in the context of this discussion. An example of that recently was with Australian Super, voting down the Origin takeover. I think they did that mainly on the grounds of wanting to get a better outcome for shareholders, but it's just a good example of the power that Big Super has to influence those sorts of outcomes. Thematic investing is looking at funds that, from a top-down point of view, that are focusing on particularly sustainability-related themes, such as clean technology, sustainable agriculture, healthcare, that type of focus. And then over on the right, impact investing refers to trying to get some kind of improved ESG outcome while generating a return that may or may not be a market return. That's kind of the key point around impact investing. It really is probably the most active or aggressive type of ESG investing, because you're looking to get some kind of measurable outcome, and you may be prepared to sacrifice some return as part of that. So it's a sort of a much less common type of approach that we see amongst our client base.
Let's move it to the next slide, please.
So putting this into practice, looking at some examples of funds here that that all apply negative screening. And so we've got an Australian shares fund, a global shares fund, and also Australian fixed interest. So to Kelly's point earlier, you certainly can construct a diversified portfolio that satisfies these types of ESG criteria, depending on what that is, what's important to you. The returns from these funds over on the right hand side have been pretty solid, relative to market benchmarks. So again, just reinforces that point that you haven't had to sacrifice return to invest from an ethical point of view. In most of these cases, certainly looking over a 5-year time frame for each of these funds. The DNR fund, in terms of their negative screen, is looking to exclude things like pornography, gaming, armaments, tobacco, and they also have a positive screen which includes identifying companies that they believe have got enhanced ESG policies. That's DNR. There's Australian Share Fund. by the way, I should just mention, we're not including these as recommendations. These are really just to kind of, to give an indication of the sort of products that you could be using to build a diversified portfolio that, that would be considered to be an ethical portfolio for, again, depending on what you're looking to, to implement in terms of your values, because, these negative screens may or may not be the sort of thing that you're looking to, to do in practice. ETHI is the so that's the ticker for the BetaShares Global Sustainable Leaders ETF, ETHI. That's an exchange traded fund. It passively tracks that index that we saw a couple of slides ago. That particular index was put together, it was custom built by NASDAQ for BetaShares, and that's what this ETF tracks. So its focus is to basically, it's got negative screens in there, and also has a positive screen to identify companies that it believes to be climate leaders. The 1 year return is it's been pretty impressive. It's 28%. That a lot of that is to do with the performance of the tech sector, and a lot of that is attributed back to Nvidia. If you kind of look at it from a global shares point of view, this fund doesn't have any of the Magnificent Seven companies other than Nvidia and also Apple. So they're like, just to give you an idea as to how that sort of, there's negative screens and also positive screens work in practice. So Tesla and also Meta were excluded for certain controversies, while Microsoft, Amazon, Alphabet didn't qualify as climate leaders, to be included in that portfolio. And then finishing off, the Pendle Fund, which is a sustainable Australian fixed interest fund. They have certain negative screens in that portfolio, which excludes things like tobacco, controversial weapons, alcohol, gaming, and also uranium. So that's how that sort of fund works, by excluding fixed interest or bonds effectively that would otherwise fit into a bond fund. Bonds have been, those returns don't look particularly impressive, but I guess it's been a difficult environment for bonds. With rising interest rates, they can look like they're not performing, but there's certainly a story as to why bond funds have been returning such low returns recently. It's probably getting slightly outside the context of this discussion, but we still believe having some allocation to bonds would still be a good thing to have in the portfolio, despite returns being
still plays a role with that.
Recently. They do, certainly from a defence point of view.
Sorry, I didn't mean to talk over you there.
No.
All right, next slide. Has it moved? Yeah. So just having a look now at some of the options within superannuation. So super fund trustees have a legal duty to act in the best financial interest of their members. And a lot of them are now identifying that ESG factors can be financially material. They're a source of investment risk as well as opportunity. So we've got 3 options here that we'll talk a bit about, and we're comparing them to the SR Balanced Index, which is I believe it's a super ratings index that was put together. It tracks the performance of 50 options with exposure to growth assets between 60 to 76%. So that's important. So an important point is we're comparing similar investment growth level, so the under the hood level of growth exposure, comparing like for like. So Aware Super, they've actually got 4 socially conscious investment options that are all certified by Responsible Investment Association of Australasia, that RIAA that David mentioned earlier. They're managed according to specific restrictions and exclusions, so what they call screens. We've got climate change as a screen, ethical as a screen, and conventions and controversies. So I just sort of give an example of one of those screens. So for coal, the description is thermal, energy, and metallurgical coal mining. extraction, production, refining, and processing. So they have a threshold. This doesn't mean they were 100% excluded, because they've got a threshold of 5% or more revenue just derived from companies that have exposure to that area. So that's an example. Coal is a climate change screen, and alcohol, any companies that have 5% or more of their revenue from the production of alcohol, that's an ethical screen. And there's a long list. We won't go through all of those, but just to give you some examples. Then we have Australian Retirement Trust. So they use ESG integration. They do some stewardship, which is, as David explained, is some engagement and I guess voting shareholder-wise. And they also sometimes apply exclusions. So their particular, the socially conscious balanced option, it's certified by the responsible, or the RIAA. And some examples of their exclusions. So they exclude thermal coal, similar to Aware Super. So the description is mining of thermal coal, including lignite, bituminous, I can't pronounce half of these, anthracite and steam coal, and its sale to external parties. And similar to Aware Super, there is a threshold that they apply, so no more than 5% of revenue. So if they have higher than that, they won't be included. And then Australian Super, so they have an ESG and a stewardship program that they generally apply, but then for their socially aware option, they apply additional screening. So they try to remove companies that directly own thermal coal, oil, or gas reserves, as an example. They also have other things like having single gender boards for S&P ASX 200 companies. So there's a number of different filters. And again, without going through knowing what their exact thresholds are, they can still invest in companies that maybe have some indirect exposure. So there's direct exposure, the company that actually derives their revenue from the activity, and then indirect. So it could be a company that provides office supplies to a company, or maybe they facilitate the transportation of a good from one place to another. So I guess it depends on your level of comfort. But that's, yeah, it's just some examples, and you can see the returns there in comparison to that benchmark, outperforming just for that period of time. It's always important to look at multiple periods of time, but you're not having to sacrifice returns necessarily to invest in line with your values.
I think that's really, that was one of the things that I was most interested in this comparison, Kelly, was the, looking at performance, and because we can see here that relative to that SR50 balance index, which is not an ethical index by any means, that's just a median return for balance strategies, regardless of any kind of ethical criteria. And over 5 years, two of those funds, top two, and these are the three largest sort of super funds in Australia from industry funds. Two out of three have outperformed, and the Australian super is really only just behind. So yeah, interesting to kind of to observe that from the point of view of how ethical funds have been performing relative to mainstream funds.
Yeah, and it's probably worth mentioning this is not an exhaustive list. As David said, this is the top three. There are lots of super funds moving in this direction because there is that awareness that this movement to, well, they have the legal duty to act in the financial interest of their members, but it's, it's a source of investment risk, but it's also an opportunity. So there's a lot of super funds doing a lot of this type of investing. So if you're keen, probably just have a look at what your existing super fund is doing, and consider your options. All right, so we'll move on from there. I think you're going to have a talk now, David, about greenwashing.
Yeah, I guess greenwashing can mean different things to different people. We mainly we're thinking about greenwashing here from the point of view of, are investors getting what they're paying for when they sort of invest into certain funds that claim to be, have an ethical mandate. And I guess from that point of view, greenwashing really is, misrepresentation by the super fund or the investment provider, the extent to which that fund is environmentally or climate friendly, sustainable, or ethical, depending on how it's marketed. And ASIC has really been focusing on this issue. They've had some high profile wins recently. Large fines handed out to funds just over the past year for misleading members about sustainability claims. And I think those cases have centered on funds telling members that they were going to avoid certain sectors such as fossil fuels, alcohol, gambling, that sort of thing, and then having companies in the portfolio that that were in those sectors. So pretty clearly not meeting that criteria, and that resulted in some fairly substantial fines being handed out. I guess the other thing is that a lot of super funds are making claims at the moment, signing up to be on the pathway to net zero by 2050. And I guess the ASIC's also come out and said that funds need to be able to demonstrate and be able to back up those claims if they're going to make those sort of claims. So
yeah, I would say that's a type of greenwashing, isn't it? Making vague or unqualified claims, or not being able to substantiate, just saying that you've got this goal but no actual plan in place on how you're going to get there. That's not acceptable. That's just going to attract people, but then you're not actually doing what you say you're going to do. So
so I guess ASIC is the main kind of regulator for consumer protection in financial services. It's one of its sort of key roles, and it's really just doing its job in making sure that funds are true to label. From a consumer point of view, that's a good thing. It's making it harder for funds to get away with greenwashing now and sort of into the future.
And I think there are probably some. It's not just the super funds; it's just generally companies as well. So I think there was an example. I can't remember which company, but they redesigned their lid and plastic straw to be straw-free. But the new lid that they created ended up actually using more plastic than the original product. So they got in trouble for that. That's greenwashing, or an example, one version. Do we move to the next slide? All right, so if responsible investing is something that you're interested, you might now be asking yourself how to get started. Really important. The first thing is to consider what matters to you, because ESG or ethical investing, I think we've said it a few times today, it's going to mean different things to different people. One person may connect more to a particular issue than the next person. So to ensure your investments are aligned to your ethical standards or values, you really need to identify what those are to you. Pre-made investment options are available through the industry super funds. So that makes this type of investing accessible to most people. And these days, it's pretty easy also if you wanted to do some personal investing outside of your super fund, no matter the balance that you've got. If you're building your own portfolio, some useful resources are the ESG ratings. So you can go to the different rating agencies. I think there's different rating houses use different systems, so just be aware of that. But also you can have a look at the Responsible Investment Association of Australasia, or RIAA. We actually also help clients here at BDO. So if a client comes to us with a mandate, we're able to help them build portfolios around their own specific preferences. So yeah, we're here as well if you need help and want to be pointed in the right direction or have us build a portfolio for you. Would you add anything to that, David?
Probably just to say that the work that we do with families and individuals in terms of managing their investments, sometimes that will include being asked to design a strategy from an ethical standpoint, which is what we've been talking about today, and we can certainly assist with that. Although we deal with a range of situations which other clients don't invest ethically, but then they still support various sort of philanthropic initiatives. So there's certainly a range of approaches. We can definitely help if someone wanted to look at putting a strategy together from an ethical point of view. We can certainly help with that if you'd like us to.
Apologies, everyone. We just had a bit of a technical issue with my internet, but I'm back. So I think where we left off, I was just reading out one of our pre-registered questions, and it was, how do I find a breakdown of what companies ETFs are made up of? So my initial thought on that is that most providers actually do have a list on their website, so especially for ETFs. So you could, sorry about that, technical issues.
That's better.
Okay, that should be now. So Ethy was the example we were talking about. It's an ETF that's the provider is BetterShares. If you go to the BetterShares website, they will offer a breakdown of each of the holdings. And even for the super funds, if you go to, say, the Australian Retirement Trust option that we talked about earlier, they have a link in their website. So you can actually go in and you can see a list of their underlying holdings at a given point in time. Might not be updated every day, but it would be to, say, the 30th of June 23. Would you add anything to that, David?
Yeah, I think we're not far away from some regulation requiring funds to disclose holdings. Some do it better than others, but if you do your homework, you can often find exactly what is in a portfolio. If you go looking, it might not be the most up-to-date information. As you said, that Ethy, which is the ticker for the BetaShares Global Sustainability Leaders Fund. If you jump onto the BetaShares website, you can actually have a look and see all of the holdings, including how much is held in each company that sits inside that ETF.
Yeah. Okay, another question that we had is, how much of this type of investing is greenwashing and what is the evidence it is not? I'm not sure that we're fully able to answer that question, but I think what you need to do is do a deep dive into, if you've got a question about a specific investment, do a deep dive into that fund's investment philosophy and their underlying holdings. You can check things like certification by the RIAA. So this is more looking for the evidence that it's not. Yeah, I think this ties into that previous question of how do you find a breakdown of what a fund is investing in. It's just doing that homework and really looking into the fund itself or the product itself. I think that is all of our questions for now. David, did you have anything else to add before we wrap up?
No.
No. All right, well then, that brings us to the end of this webinar. So I just want to say thank you to everyone for attending. Thank you, David, for your valuable insights. I'm sure everyone agree it was a great session. Before we finish, we do have a short survey that will pop up at the close of the webinar. So we'd appreciate if you could take a couple of minutes just to help us improve our future webinars. And also, if you do have any suggestions on future topics that you would like to see, we are open to hearing about that. So please let us know.
Thanks, Kelly.
Thanks, everyone.